Financial bubbles are indistinguishable from the adoption of new technology. This is the first sentence of CoinGecko's recent quarterly report on the cryptocurrency market, and there is a lot of truth to that statement. Since the start of the year, cryptocurrencies have seen record adoption, growth, and innovation. Whether it's Tesla buying Bitcoin, Coinbase going public, or Thorchain launching the first ever cross-chain DEX, there is no question that what we're seeing in crypto is much more than a bubble. These many milestones constitute a watershed moment for the entire crypto industry and mark the beginning of the global presence it was destined to have since Bitcoin began in 2009. Today, I'm going to take you through a few of the top crypto trends that are taking the world by storm and what they could mean for this bull market and the future of cryptocurrency. I hate to spoil the fun, but a disclaimer needs to be done. Nothing in this video is financial or investment advice. It is purely for educational and entertainment purposes, if we're being precise. Financial advice is just not my cup of tea, so if you happen to be looking for it, then you'd better not be looking at me. If this is your first encounter with the Coin Bureau Brigade, my name is Guy, and I think crypto is as good as getting laid. This channel is home to some of the highest quality crypto content on the internet. Cryptocurrencies, big and small. Tips and tricks, you'll get them all. Crypto news and market moves and other valuable knowledge that you can use. If this sounds too good to be true, subscribe to the channel, ping that notification bell, and I'll show you. On that note, take a second to skim through the timestamps I've left in the video timeline. If you want to skip around, that's fine, but I'd love it if you watch the whole way through because YouTube ranks videos based on watch time. Now that you're all set, let me tell you why no coiners are about to get wrecked. Did you know that Bitcoin is the best performing asset of the decade? Since 2011, BTC has gone up by more than 20 million %, outperforming every other investment vehicle in existence during that time. Bitcoin's market cap also recently exceeded $1 trillion, which would make it the sixth largest company in the world by market cap, beating Facebook by a few $100 million. More importantly, Bitcoin's market cap is about 1/10 of the market cap of all the gold in circulation. Now, this is significant because BTC is likened to digital gold since it derives much of its value from its scarcity and maximum supply of 21 million. As such, many believe it is only a matter of time before Bitcoin becomes as big as gold, and others believe BTC could even become much larger since it's much easier to get, easier to store, and easier to transfer. This makes Bitcoin an optimal hedge against inflation, and this hedge seems to be the reason why so many institutions have started to buy BTC in recent months. 40% of all US dollars in existence were printed last year to keep the corpse of the economy lurching along. This would theoretically lead to an inflation rate of 40%, all else being equal. Now, all else has not been equal, but that's a topic for another time. Anyways, while the inflation from all this money printing has not fully revealed itself in everyday goods, it is clearly visible across all asset classes, primarily housing, stocks, and cryptocurrencies. As explained by Heresy Financial, the reason for this is basically because corporations and consumers can't do anything else but buy assets with that stimulus money. In theory, corporations should be spending that stimulus money to sustain or even expand their operations, but this is futile when everything is closed, since that investment would not yield a profit. Moreover, many of these stimulus packages have restrictions on stock buybacks. This means the only option most corporations have with their stimulus money is to buy other stocks or assets such as cryptocurrency. That stimulus money would lose value if they just kept it in cash. Similarly, consumers are being cautious with their money and in some cases can't even spend it if they wanted to because everything is closed or out of business. This likewise leaves consumers with no other option but to save that stimulus money or invest it in assets. Individuals and institutions have consequently been accumulating BTC like mad, with PayPal and Square collectively buying 100% of all the newly mined BTC in March of this year. That might leave you wondering what would happen if most or all the BTC in existence was purchased by investors with deep pockets. Well, it's first worth pointing out that only about 1% of Bitcoin's entire supply is currently held by publicly traded companies. This number rises to about 6.7% if you include the treasuries of companies both inside and outside of the cryptocurrency space. Now, even if that figure was 67%, I reckon it would be the same situation we have now with other limited assets like gold and land. There will always be someone somewhere who's willing to sell. If you're wondering what happens when all the BTC is mined, I happen to have a video about that, which you can watch using that handy link in the top right. The notion that Bitcoin's recent rise is due to its use as a hedge against government printing is quite a contrast to the common crypto belief that stablecoin printing is the real culprit. Stablecoins have also seen record growth over the last few months, with their collective market caps more than doubling from $30 billion to over $60 billion. Although most of this market cap gain came from Tether's USDT printer, USDT's dominance as the top stablecoin seems to be coming to an end. The market cap of Circle's USDC stablecoin is growing at twice the pace of USDT's, and this has been the case for quite some time. There are many reasons for this, but the main one is trust. Unlike Tether, Circle is based in the United States. It's heavily regulated and frequently audited to ensure that all the USDC in circulation is fully backed by US dollars. The market cap of Binance's BUSD stablecoin has seen strong growth for similar reasons. Besides being a product of a partnership with another US-regulated issuer called Paxos, BUSD is front and center on the Binance exchange. Given that more than 60% of all trading volume in cryptocurrency is now taking place on Binance, it should come as no surprise that BUSD's market cap has almost tripled since the start of 2021. However, the fastest growing stablecoin of them all is Terra's crypto-collateralized UST stablecoin. The market cap of UST grew by a whopping 8 times in Q1 and currently sits at around $1.8 billion. This is because Terra's Mirror protocol is quickly becoming the go-to platform for synthetic stock trading, with nearly $500 million of synthetic stocks minted at the time of shooting. The annual percentage yields for providing UST collateral and liquidity for these synthetic stocks can exceed 200%, which ensures a low slippage trading experience not found on similar protocols. Terra's Anchor protocol also recently launched, making it possible to earn a stable interest rate of 20% per year on the UST stablecoin. Yeah, you heard that right. A high, stable interest return on a crypto-collateralized stablecoin. Who needs banks? Now, if you want a more in-depth explanation of Terra, Mirror, and Anchor, you can get it by clicking that link in the top right. Terra is just one of the many cryptocurrencies that make up the DeFi ecosystem, which has also seen exponential growth in recent months. The total value locked in DeFi across all cryptocurrency blockchains recently breached $100 billion, a 5x increase since January. About 60% of this TVL is on Ethereum, 35% is on the Binance Smart Chain, and the remainder is scattered across other blockchains like Terra and Ethereum Layer 2s like Polygon and XDAI. The TVL in Binance DeFi has grown the fastest, with a 100x increase in TVL since the start of the year. Now, I will caution that these figures carry a few caveats. For starters, most of the total value locked on Ethereum and Binance depends on the price of ETH and BNB, respectively. According to DeFi Pulse, just under 40% of all the TVL in Ethereum's top DeFi protocols is made up of ETH. According to DeFi Station, the BNB in Binance's top DeFi protocols makes up about 50% of its total TVL. While it's questionable if protocols on the Binance Smart Chain can be considered DeFi, given the centralization of its blockchain, there is no question that a lot of that TVL is being stimulated by Binance. In addition to pouring hundreds of millions of dollars into projects building on the Binance Smart Chain, Binance has also been actively providing liquidity incentives to these projects. This is being done directly through liquidity grants and through Binance Earn, which seems to be connected to protocols on the Binance Smart Chain. Moreover, Binance has been burning BNB on a quarterly basis. As with Bitcoin's halvings, a reduction in supply leads to an increase in price, assuming demand stays the same. The demand for BNB has been increasing thanks to Binance's marketing of the Binance Smart Chain, leading to an increase in price, and consequently the TVL we see in Binance DeFi. That said, there is no question that the Binance Smart Chain is a convenient alternative to Ethereum, which continues to be plagued by high gas fees. Besides Terra and the BSC, so-called Ethereum killers have also been gaining momentum. These include Solana, which hosts the Serum order book DEX, Avalanche, which hosts the Pangolin AMM DEX, and a cryptocurrency project called Phantom, which has close ties to Yearn Finance founder André Cronje and has consequently begun hosting popular Ethereum DeFi protocols like Yearn and SushiSwap. Now, I'd be remiss if I didn't mention at this point Cardano and Polkadot, though these two have yet to launch any DeFi dApps. Polkadot should be starting its parachain slot auctions within the next few months, and Cardano has set its smart contract release date for this summer. Given the impressive gains DOT and ADA have had without smart contracts so far this year, there's no telling where the ceiling will be when they reach their final forms. I'll leave my most recent updates about both projects in the video description in case you missed them. If you think DeFi is the hottest crypto trend right now, well, you've probably never heard of NFTs. The market cap of all NFT-related cryptocurrencies currently sits at a whopping $30 billion. The trading volumes on NFT marketplaces like Rarible and OpenSea have gone up by nearly 20x since the start of the year, topping $200 million in March. Cumulative sales for NFT collectibles from NBA Top Shots, CryptoPunks, and CryptoKitties were over 700 million during the same period. Now, if you include other chunky NFT sales like Jack Dorsey's first tweet, this cumulative sale figure goes well above $1 billion. Jack's $2.9 million tweet pales in comparison to the most expensive NFT sale, which was, of course, Beeple's collection of his first 5,000 works that sold for nearly $70 million at a Christie's auction in March. While it's quite clear that the NFT market is in a bit of a bubble, many of its platforms are starting to see some serious adoption. Take Audius, for example, a decentralized music streaming platform built on Ethereum. Audius only launched in the fall last year and already boasts more than 3 million users. Now, this is no surprise given that musicians can earn substantially more by selling their tracks and albums as NFTs or streaming them on platforms like Audius than by doing the same on Spotify or Apple Music. As with Bitcoin, legacy institutions are starting to dabble in NFTs as well. Charmin has sold tokenized toilet paper, Pringles sold a tokenized tube of chips called Crypto Crisps, and Pizza Hut has begun selling weekly pizza slice NFTs. McDonald's France also recently began the contest for its Big Mac and Chicken Nugget NFTs, and I'll leave a link in the description if you want to try your luck. To add to the insanity, NFTs are slowly becoming a part of DeFi. Projects like NFT20 are making it possible to use NFTs as collateral to mint ERC20 tokens representing the locked-up NFT, which can then be freely traded on decentralized exchanges like Uniswap. Not only that, but NFT20 has incorporated Aave's flash loan feature to make it possible to borrow all the NFTs on its platform for a single Ethereum block to execute an arbitrage trade of some kind. Other projects like Metacartel's Rocket Protocol make it possible to take out crypto loans using digital land in decentralized virtual worlds like Decentraland as collateral. And just recently, the first ever NFT art plus house combo went up for sale on the OpenSea marketplace. So if any of you fancy moving to Cali and buying a house there, you'll get an NFT into the bargain. Now, there's one more crypto trend I want to discuss, and it may be the most important of all: regulations. With all the buzz crypto's been causing, governments around the world have naturally taken notice of this new financial frontier. Given the increasing weakness of their own centrally controlled fiat currencies, it's logical to think that some sort of regulatory crackdown is coming for the crypto space. This is what we keep hearing from the so-called experts at various organizations like the World Economic Forum. However, There have been numerous developments over the last few months to suggest that this is nothing more than FUD. For example, multiple Bitcoin and Ethereum ETFs were recently approved in Canada. These have accumulated more than $1 billion of crypto assets under management in their first few weeks of trading. CME also launched its ETH futures trading in February and has seen more than $500 million of trading volume and open interest since then. Visa recently partnered with Circle to test run settling card payments using USDC on Ethereum. Grayscale has also launched multiple trusts for altcoins which have seen hundreds of millions of dollars of institutional investment. And heck, even China is considering reversing its 2017 crypto trading ban. Now, if regulators around the world were truly looking to kill crypto, then why would they be approving these things and signaling their support for even more regulatory leeway? Now, one of the only exceptions here is Turkey, which recently banned cryptocurrency payments. Turkey's central bank said that this was because of the, quote, irreparable damage caused by crypto payments. Though it does not specify what this damage is, I suspect it has to do with the tanking value of the Turkish lira and the fact that Turkish citizens are using cryptocurrency more than ever as a result. Now, it's worth pointing out that China has hinted at similar restrictions on cryptocurrency payments if or when it gives the go-ahead for crypto trading. Taken together, these facts suggest that cryptocurrencies will not be met with harsh regulations unless they begin to threaten a government's monopoly on money. If anything, it appears that governments are both able and willing to put up with this continued growth and might even be interested in accelerating it if it means that they get a tax cut of our hard-earned gains. Besides, governments need people in the crypto space to do the work so they can copy it to build their central bank digital currencies. Too bad it'll be too late by the time they roll them out. Bitcoin is getting bigger by the day, but that's just half the story. The other half of the story is that fiat currencies around the world are losing value at a record pace, and people are starting to realize that they're better off holding magic internet money than so-called real money. In the past, people would have held precious metals to protect against inflation, but something tells me we won't see people paying with gold or silver as long as the internet is up and running. The funny thing about the concerns around the rich buying up all the Bitcoin is that it assumes that they aren't thinking about the economy in an outdated manner. There's a reason why most of the individuals and institutions buying Bitcoin are at the cutting edge of technology. By the time the old heads realize what's going on, we will be laughing our way to our own self-custodied Bitcoin banks. For the time being, though, we too are tethered to the supremacy of dollar-backed currencies. I, for one, am thrilled to see that the free market is doing its job in the crypto market when it comes to USDT, USDC, and BUSD. It's also encouraging to see a crypto-collateralized stablecoin that is both able to hold its peg and isn't partially collateralized by centrally controlled stablecoins like DAI with USDC. The ability to earn stable interest on stable assets is a seriously big deal, and I think Terra's Anchor protocol is the first of many protocols that will make this possible. It's only a matter of time before these stable interest protocols become an integral part of the DeFi ecosystem. Decentralized lending, borrowing, trading, and saving could soon become the new normal, and at that point, the only thing missing will be an optimal peer-to-peer payment currency. NFTs are also not going away anytime soon, even if their valuations are dropping in the short term. While I don't think Pizza Hut's weekly slices will become the new CryptoPunks anytime soon, corporations have clearly caught the NFT bug, and that's invaluable for crypto adoption. And of course, the more adoption there is, the harder it is to get rid of. Governments are realizing that they must learn to live with crypto in some form or another. At this point, there's no turning back, and that can only mean one thing. Cryptocurrency will eventually replace the current financial system. If you fancied this crypto flick, give that like button a click. Remember to subscribe to the channel and ping that notification bell to secure your seat at the next one. If you're craving more Coin Bureau content, you can get my hot takes on Twitter and get some behind-the-scenes outtakes on TikTok. I've started doing bi-weekly AMAs on Instagram, and I do daily market updates on the Coin Bureau Telegram. If your crypto portfolio is lacking, you should subscribe to my weekly newsletter and see what it's packing. If you want to give back, you can do just that while looking like a snack by snagging some merch from the Coin Bureau merch store. Links to my socials, newsletter, and crypto merch are down below in the description. Thank you as always for your time, and I'll see you all down the line. Ta-ta!